What's going on, guys? Welcome to the fair value gap section of basic training. So, today, what we're going to do, or what I'm going to do, is I'm going to explain to you how to spot and recognize a fair value gap on the charts, which we're going to literally skim over that because that's the easiest part. But most importantly, I'm going to explain to you what it is and why it behaves the way it does. Okay, and which is something that I think a lot of people in the space overlook. They just they focus on knocking into your head how it looks, blah 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 blah. That doesn't matter because you can always go on Google, look up fair value gap, go on images, and you can see examples of it, right? What I personally think is more important than me explaining to you how to identify it is to understand what it is and why it behaves the way it does. Because this way you can make more or better informed decisions on your trading. Okay. So let's just get started. A fair value gap is a 3 candle pattern essentially, and it's when the middle candle out of that 3 candle pattern has a body that isn't touched by neither the left or the right, the candle to the left or the candle to the right. Yeah, either body or wick, right? So it has a body that's exposed, okay? And it doesn't have a candle to the left that either has a wick or a body touching it, or to the right, okay? So this is what it looks like. Boom, fair value gap. Whoa, it could be any three pattern, 3 candle pattern, if that makes sense. Whatever. Like I said, we're skimming over this part. Excuse me, we're skimming over this part. What's more important is to understand what it is. So, what is a fair value gap? A fair value gap is an inefficiency in price. Now, I know you probably even heard of this before, right? If you've been curious about fair value gaps. But as a beginner trader, you don't understand what an inefficiency is. That concept is foreign to you. So what if it's inefficient? Okay. Well, I'm here to explain it to you, right? Let's say, and here's the other thing with trading is that it's all psychology based upon just the overall general group of people that are trading. Okay. That's the only reason why confluences exist. It's because people allow them to exist. Okay. But let's get into an example here. Let's say you're Bob. Okay. And let's say you're looking to enter longs on NQ. Cool. Only issue is that you only want to enter longs if price manages to hold above this level right here. Okay. Or whatever your reasoning may be. Okay. Closing above this level, holding above this level, whatever. But also, you want a decent fill. So you don't want, let's say price shoots up like it did here. You're not okay with being filled all the way over here. Okay. So once you see this happening, you see a close or a hold or whatever it may be above this level, you put in a limit order. Wherever that may be. I'm assuming it would be at this level. This is your optimal point of entry. Okay. Well, I mean, sure, I guess. Actually, let's move this up. Let's say your optimal point of entry is right here. Okay. This is where, or this is the highest you're comfortable buying price at. But what happens? Okay. We close this candle closes, you put in your limit order, and right? Price doesn't come back down to this level on the next candle. So your order is just sitting there. You have a limit order. Okay. That's all a fair value gap is. It's a point in price that orders were not able to get filled in for whatever reason it may be. Or actually, the reason is because of strong buying pressure or selling pressure. Okay. And so, because of that, we're not trading within this area for very long. Okay. This candle doesn't come into this, right? So, like here, right? Let's say you have an order here, it gets filled over here because price came all the way, price close here. Price came down, filled this order, filled whatever orders there may have been right here in this area, and all good. But in this area, there is a bunch of orders that didn't end up getting filled by this candlestick right here. Okay. That's why, or that's what a fair value gap is. Okay. And that's why it behaves the way it does. Okay. Now, to further elaborate, to further explain how it behaves, cool, we have a bunch of orders sitting here. We have very strong buying pressure. On the second candle, we already came all the way over here. There, obviously, a lot of people entered in short and long positions. We traded within here a good amount. So we open up this candle. We get an opportunity to fill sell orders, buy orders, blah, 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 whatever it may be. And we have decent buying pressure. But at a certain point, buyers are like, okay, we are starting to extend too far up. Buyers start they start getting exhausted, meaning they're not willing or as willing to buy in on this or at this price at all. Like there's less people that are willing to buy in at this price. So if there's less people willing to buy in at this price and it keeps dropping, naturally what happens is sellers start coming in. Okay? People that want to short the market, that want to sell the market. And from here, price starts coming down because people are shorting, people are selling the market. Okay? And there isn't buyers, right? They're like, oh, no, I'm okay. I don't want to buy in on this. This doesn't look good. This doesn't look good. Well, remember how I told you that there is a bunch of orders over here, limit orders, that were not filled because price moved so abruptly and we didn't trade much in this area? Well, as we come down into this area, what happens? We start picking up these orders. There's orders here. So now you got buyers stepping in. And if you have buyers stepping in, we have these orders getting filled, price is going to want to go back up. Okay. That's one explanation of it, right? Another explanation could be, the orders thing here, price being inefficient always stays the same. Okay. Let's say you're an ICT trader or a SMC trader. You trade with SMC concepts. You understand what a fair value gap is, okay? And you want to wait until price enters into a fair value gap before you even enter, before you even put in an order, period. Or maybe you have your order resting over here. You're still adding on to the amount of orders that are over here in this area, in this point in price. Okay, so whether you have a existing limit order in here or whether you are waiting for price to come back down into here, the market is still picking up orders within this price range. Okay, And like I said, it's all about psychology. It could mean 100 different there could be 100 different reasons why there might be orders here. There could be 100 different reasons. Well, actually, not really, in terms of why price may retrace into this gap, right? There's a very few amount of reasons, meaning buyers are getting exhausted, or if it's a bearish fair value gap, sellers are getting exhausted and they don't want to buy in, or yeah, they don't want to buy in at this price because they don't think it's good, right? Either they don't like the price they're getting filled in at, or they're afraid that price will come back and retrace into this area, and they cannot afford to retrace back into this area, if that makes sense, right? So if you know price, if you have a feeling that price is going to come back into this area, why would you enter right here when you could just wait a little bit more time and you could get a better fill in right here? Okay. From there, once we come back in, price is rebalanced. Now, is the whole fair value gap rebalanced? No. But once we come in here, once we reject off of this fair value gap, once we bounce out of it, again, here's where the psychology comes in. This becomes almost like a level of support, like a safety net almost. You're like, okay, price already came down into here. There's no reason for it to come back down into that specific fair value gap again. So even if you are entering right over here, which is higher than when buyers were getting exhausted right here, you still got more safety. You still got more of a reason. You got more of a safety net, right? You know that the probability of price coming back down here again is very low. Okay. And that's how fair value gaps, that's the reason why they behave the way they do, right? Orders are filled or price moves up very abruptly. Orders are missed, whether it's a limit order that was not hit next to this candle right over here, the following candle, or whether it's somebody that is waiting for this exact thing to happen, right? For them to exactly enter into the fair value gap. A lot of orders are getting picked up in this fair value gap. And the main reason is because everybody knows and is familiar with a fair value gap. Okay. If everybody stopped counting a fair value gaps as a part of as a confluence, or stop seeing them on the charts, they would be pointless. Right? They wouldn't do anything. Okay. But because people know how they behave, how they expect them to behave, they know that there is going to be orders that are going to be getting filled in over here, as long as, buyers are in control, right? As long as your overall bias is bullish, people know that price is going to come down in here, and there's going to be a lot of orders getting filled in here. So then what can you do? Instead of being an idiot and buying over here, you can wait a little bit and you can buy in over here. Okay. I hope that, did a decent enough job explaining why fair value gaps, or just explaining fair value gaps in general. And they work on all time frames, right? And I can tell you the psychology behind these fair value gaps, right? Let's say you're on the hourly. Hell, okay. let's see. Let's find a fair value gap here that got respected. Okay, boom, bingo. No, that's way too far. I'm gonna have to. Oh, there you go. Let's say you're a trader that looks at the 1 hour time frame. Okay, same thing applies. Even though, yeah, sure, we may have traded a lot within this area on the lower time frames. If you are somebody that looks at the higher time frame, right? You're waiting for an entry or whatever it may be on the 1 hour time frame. Okay, shoot, cool. Price held a level that you wanted to held. You know, price gave you a reason for you to enter into the market, right? The only issue now is that you're not happy with this entry point, and price has not come down, whether it was the previous candle or the next candle, to come in and actually fill your position, right? Because you want a decent entry. Okay. So now you have an order, at least a mental order, that, hey, I want to enter within this gap right here, within this price range, wherever that may be. Okay. And if enough people think this way, what will happen? Okay, people are going to stop buying here. If people stop buying, people are going to start selling. And once they start selling, we come into this fair value gap. As long as people still think, for the majority, or at least the majority people still think that price is most likely going to go up, that's what's going to happen. Price will go up because people will, they're like, okay, hey, this is a really good place to put in my order. You know, before people rushed to put in their orders through here, now we're back into this area. Let's spam these orders. Okay. And it works with every time frame. Again, you can see some of these don't get respected the way I say they would, right? And that's because you can't just use a fair value gap by itself. You need context behind the fair value gap. You need a reason to believe that the fair value gap is going to hold. Okay. Now, for some little tips and tricks, and this isn't always the case. A lot of times it is, and I use this to my advantage. It's just something to keep in mind, or something that you could keep in mind with fair value gaps. So let's say you have a fair value gap. Okay. Boom. Usually, what are we looking at, looking for within our trading style? Is we're looking for a rejection off of a fair value gap, if that's what we're going to be entering off of. We want to see that price is respecting that fair value gap. Okay. So you're going to want to wait for it to come up. Cool. Now, let me see if I can find it in price action. A decent enough example. I'm pretty sure it works better on the higher time frames here, though. Today was not a very good day for this. Sorry guys. Let's see. We have to find this, and it doesn't always happen, but you'll notice it happening. I'm just looking for both examples here, and I'll show you. I'll tell you exactly what both examples are. Okay, actually, boom, perfect, perfect. Is it perfect? Kind of, sort of, not really. This really sucks because I really do. Oh, there you go. There you go. I'm slow. Okay, that's one. And then two right over here. It's going to get messy, but that's fine. Two. Okay. So, quick tip. Let's say you're looking for shorts here. Okay. And you are waiting for a rejection off of this 5-minute fair value gap. Okay. You're waiting for price to show that it's going to respect it. Something that you can look for to kind of give you an idea of whether this gap is going to get respected or not is how it closes. Now you're going to notice that I have this line in the middle of my boxes for me to that I use to map out fair value gaps. And this is 50%. This is dead smack middle of the box. And if I map out a fair value gap with this box, the middle line would mean the middle of the fair value gap. 50% of the fair value gap, equilibrium of the fair value gap. So, more often than not, if price ends up closing above, so let's say you have a bearish fair value gap right here. If price ends up closing above this equilibrium on the respective time frame, it's most likely not going to hold, or there's a very good chance that it will not hold, like it did right here. Okay, it closed well above this 50% line, and guess what? It did not hold. We kept going up. Whereas with this fair value gap, I mean, we didn't even close here, right? We didn't even close within this fair value gap. So this is a little bit, I guess you could say, counterintuitive. Oh, there you go, right here. And again, take this with a just very thin grain of salt, because this is like one of those things where it's like, don't really think too hard about this. This is just something cool I noticed in price. Here, this fair value gap, sure, did we wick all the way past this gap? Yeah, but we never closed below this 50% line. And would you look at that? Boom. Again, are there inconsistencies? Like, for example, right here? Yes. We did close below. We even had another candle that closed below this 50% line. And it still held. So that's one use for this 50% line. Another use, and I actually like to use this for take profits. Especially on higher time frame gaps, but I'll still use a 5-minute gap here to showcase it. When a gap gets retraced into, there's a good shot that it's going to come to the 50% line. So retrace, or actually, let's not even use the 5-minute gap here, because you wouldn't take profits, or you would rarely take profits off of a 5-minute gap. We can use this new week opening gap though, for sure. Oh, I don't even want to use the new week opening gap. We can use this gap right here. Okay, boom. This is from today actually, so that's perfect. Okay. Let's say you short somewhere right here, but you have a fair value gap. Okay. Hourly fair value gap right here. And you're bullish. Price action is bullish, but it needs to retrace, right? Like I said, it needs to fill in those orders buyers are getting exhausted. We need to pick up more buyers over here. There's very high possibility, very high likelihood that buyers are going to be within this range. Okay. But you're very certain that price is going to come down into this gap. Okay. So what you do is you take a short position. But here's where it gets a little iffy. Okay. This gap is huge. It's a 168 point gap, give or take. So you are missing, if you put your take profit on this short position at the wrong level, you could be putting a lot of profit out on the table. Right? You could be leaving a lot of profit on the table. What I noticed though is, unlike with the closing, in terms of filling in a gap, especially these higher time frame gaps, either they get filled in fully, most of the time it's with just a wick, or at least a lot of times. Sometimes it's with just the wick, sometimes it's with a body, depends. But they are more than likely going to get filled in to at least 50%. Now, of course, is there times where it just barely touches in, it shoots up? Yeah, sure. Okay. But if I'm going to be basing my stops or my take profits on a fair value gap, I'm going to definitely keep in mind that there is a very good opportunity that price is going to want to come to fill at least 50% of that gap. That's what equilibrium is, right? It's not always the case. It's just a little thing to keep in mind. And these little extra bits are going to come with market experience, and you're going to understand when to use them with market experience. As a beginner trader, you're like, okay, what are you talking about? So you're telling me that there's a good chance that it's going to get filled here, but not always. So how can I be sure? Just, again, context. Context. This video is getting really long, so that should be all in terms of fair value gaps. Hope you guys understood. Hope you guys learned a lot, and I'll see you in the next one.